Welcome to the second lesson of our Fundamentals of Options Trading course. This lesson will be about option moneyness. In particular, we will split options into three groups in terms of their moneyness. First, we'll talk about in-the-money options, and then at-the-money options, and finally, out-of-the-money options. And at the end of the lesson, we will also link option moneyness to intrinsic value. Okay, let's get started with in-the-money options. The concept of moneyness is all about the relationship between the strike price and the stock price. So strike price is basically contractually specified. So for example, if you bought a call option contract on Tesla shares and the strike price is, let's say, $50, so this means that you can purchase Tesla shares for this predetermined price, regardless of what the prevailing stock price is. But of course, this sort of contract is only valuable under certain circumstances, and that is determined exactly by this relationship. In general, an in-the-money option is valuable in the sense that if you could exercise it right now, it would yield a positive payoff. In other words, if I could exercise the option right now, I would make a profit. Okay? And because they are valuable, in general, in the option money contracts cost more. So if you want to buy in the money options, you also have to pay more money, precisely because they are more valuable. To understand this concept, we will now look at more carefully to both call options and put options and try to understand when they are in the money. So for call options, they are in the money when the current stock price exceeds the strike price. So let's remember also what a call option is. Basically, it gives you a right to buy the underlying asset. So let's say Tesla shares. Now, the payoffs of the call option at expiry would look something like this. So let's say this is the stock price, and this is the payoff you would get. And this point is actually the strike price. Okay, so let's say this is again $50. And let's say on the day of the expiry, Tesla shares are worth $100. Okay. Now, this option is highly valuable because it gives you the right to buy the underlying stock for $50 while the market value is $100, right? So then you can just pay $50 for those shares, and if you wanted, you could sell them in the open market for $100. So this option here at a price of 100 is in the money because it yields a positive payoff if you can immediately exercise it. For the put options, the relationship is opposite. So put options basically give you a right to sell the underlying asset, right? And they are in the money when the stock price is below the strike price. So let's try to understand why. So if the strike price is again $50, now and the current price is $100, this is not valuable, right? So why would you exercise this option and sell your shares at 50, where in fact the current market price is 100? You would want to sell them for 100. But suppose the current stock price is actually 25. Now the put option is in the money because the shares in the market are worth $25, right? But you could actually sell them for 50. So this is an immediate payoff of 25, right? 50 minus 25. So for the put option, they are in the money where the stock price is less than the strike price. So when we are in this region, so this is the in the money region for the put option. Whereas for call options, the in the money region is when the stock price exceeds the strike price. Okay. The next category is at the money options. And this is sort of a knife edge scenario where the current stock price exactly equals the strike price. Now, strike price is fixed, right? So let's say again it's $50, where stock price constantly fluctuates. But if it happens to be that at some points the stock price is exactly 50 as well, then we would say the option is at the money, right? And in that case, when the option is at the money, if you exercise it right now, it would just imply a zero payoff, right? Because the market value exactly equals the contractual strike price value, right? So there's no gain or loss from exercising this option. So that's why we call it at the money. And this is true for both call options and put options, right? So for the call option, again, if we go back to that payoff schedule, so this is the $50 strike price, or the exercise price is the same thing. So if the stock price is also 50, we are at the money. So it is really a single point, right? It is exactly this point. The same is true for the put option. The put option is also at the money if the stock price equals the strike price. So we are looking at exactly a single point, right? Where you are indifferent between exercising versus keeping the option. And finally, the out of the money options. I think you can by now guess where this is heading, right? So this is the case where the exercise would yield actually a negative payoff, which means that you wouldn't exercise it, right? So the nice thing about the options is that it gives you the right, but not the obligation. So your payoff would actually never be negative simply because you wouldn't exercise it. So it would be zero payoff, right? But if you were silly enough to exercise it, essentially you would be having a negative payoff, right? So these are out of the money options. So currently they are not valuable to exercise immediately, right? So, but it doesn't mean that they are worthless. They are cheaper than in the money options. So they would cost less than in the money options. And why would they not be just free? Because basically an option that is out of the money now can become in the money later on, depending on the stock price movement, right? Stock prices are dynamic. So the contract will be valid, let's say, for a month. It might be out of the money now, but later on, it might become in the money. So again, let's compare call options and put options, and let's find the regions when they are out of the money. So going back to the payoff schedule for call options, so remember, this is the in the money range. So let's just write in. This point is at the money, and this remaining range is out of the money range, right? So this range is out of money. Again, let's try to understand why. So let's say this is our $50 exercise price. So let's say we are here, $25. Now remember, the call option gives you the right to buy the shares. So why would I buy them at $50, which is the exercise price, when I could buy the same shares for $25 in the stock market? So that's why it doesn't make sense to exercise this option, because the implied payoff would be negative. So you are better off not exercising. Again, for the put option, we have the opposite scenario. So for the put options, they are out of the money when the stock price exceeds the strike price, right? So for the put option, this is the in the money region. Let's say, in put. So this is in the money for calls. And again, this is the point where both the put option and the call option is at the money. Now, this was the out of the money region for call. And as you can guess, this is the out of the money region for the put option. Okay. Yeah, here we are. Again, let's try to understand the intuition. So let's say the stock price is here $100. So I'm much better off selling my shares for 100, which is the current market price, rather than at the exercise price of 50. So that would imply a negative payoff. So I shouldn't exercise my option. So that's why at the moment it is out of the money. But like I said, let's say this put option has still 1 month until expiry. So while the current share price is 100 now, imagine it falls to 25. Of course, it's very unlikely in 1 month, but let's assume it happens to be the case. Then essentially you are moving away from the out of money region into the in the money region for put, and exactly the opposite for the call option, right? So that's why out of the money options cost less, because right now they are not valuable, but it doesn't mean that they are completely worthless. They might become valuable by the time you approach the expiry. And that brings us to the final thing I would like to discuss, which is the relationship between option moneyness and intrinsic value. So the total value of an option contract, so this can be a put option or a call option, doesn't matter, has two broad components. One is the intrinsic value, which is very much related to the concept of moneyness, and the other component is the time value. So the time value is actually the potential of the stock price to move in a way that makes the option valuable, which is what we discussed just before, right? So the option might be out of the money now, but there is time until expiry, so it might turn out to be valuable later on, depending on the stock price movements. Now, in the money options have positive intrinsic value, right? In the money options have positive intrinsic value, which means that if I could exercise it right now, my payoff would be positive, right? Positive payoff. So that's where the intrinsic value comes from. Whereas out of the money options, options have zero intrinsic value, right? Why? Because they are not worth exercising right now. But again, even if the out of the money option might have a zero intrinsic value, doesn't mean that this is zero as well. The option value could still be valuable. The option value, can still be positive. Let's say it might be 10 because of the time value. But let's say the contract approaches to the expiry date, and still it is out of the money. This time value will decline as well. So it's essentially decays over the life of the contract. So on the date of the expiry, the time value will actually become zero. It will drop down to zero. So the entire option value will depend on the intrinsic value. So if on the day of the expiry, the option is out of the money, then the intrinsic value is zero, and the option value will then be zero as well, right? Because there's no time value left. All right, that's all I wanted to cover in this video. Here is some homework for you, some true or false questions to test your learning. You can find a link to the solutions if you check the video description. Have a look at them, and hopefully they'll be helpful. And in the next lesson, we'll be learning about what determines option prices. So we will look at basically sensitivity to various factors. And thank you for watching this video, and hope to catch up in the next one. Bye for now.